Look, I'm going to be direct with you. What I'm about to share isn't some get-rich-quick scheme or investment fad. This is about understanding what's happening right now in the global financial system and why the smartest money in the world is making one very specific move. Central banks around the world just added over 400 tons of gold to their reserves in the first half of this year alone. That's 24% above the 5-year average. Think about that for a second. These are the institutions that literally print money, that control interest rates, that have access to every piece of economic data before anyone else sees it. And they're buying gold at record levels. Why? Because they see something coming that most people aren't paying attention to. And by the time the average person realizes what's happening, it'll be too late to position themselves properly. Let me paint you a picture of what's really going on. Gold just surpassed $4,000 per ounce for the first time in history. It's doubled in value in under 2 years. But here's what's fascinating. This isn't being driven by retail investors panicking or some temporary crisis. This is structural. This is institutional. This is the foundation of the global monetary system shifting beneath our feet. You know what's interesting? When you look at the data, central banks have been net buyers of gold for over a decade now. But something changed recently. The pace accelerated dramatically. We're not talking about small, incremental purchases anymore. We're talking about massive accumulation at levels we haven't seen since the early 1970s. And if you know your history, you know what happened in the early 70s. That's when Nixon closed the gold window. That's when the entire global monetary system fundamentally changed. That's when we went from money backed by gold to money backed by, well, nothing but faith in governments. For 50 years, that system worked. Sort of. But now? Now we're seeing the cracks. Let me tell you about something most people don't understand about how gold actually trades. There's physical gold, the actual metal you can hold in your hand. And then there's paper gold, futures contracts, ETFs, derivatives. The paper gold market is massive. Estimates suggest there are anywhere from 100 to 250 paper claims for every ounce of physical gold that actually exists in vaults. Think about that. It's like a bank that loans out the same dollar 200 times, hoping everyone doesn't show up to withdraw at once. And guess what? People are starting to show up. China's been particularly aggressive. They've been buying gold month after month, adding to their reserves consistently. But here's the thing. Many analysts believe China's actual gold holdings are far higher than what they officially report. Why would they underreport? Because if the world knew how much gold they actually had, it would signal their intentions too clearly. It would show that they're preparing for a world where the dollar isn't the dominant reserve currency anymore. And they're not alone. Russia, India, Turkey, Poland, countries all over the world are diversifying away from dollar reserves and into gold. This isn't conspiracy theory stuff. This is official central bank data. This is happening right now, in broad daylight. But let's talk about what this means for you personally, because that's what really matters, right? If you're holding your wealth primarily in cash or cash equivalents, you're essentially betting that governments will continue to manage their currencies responsibly. You're betting that inflation will remain under control. You're betting that the dollar will maintain its purchasing power. How's that bet looking lately? I'm not even talking about the official inflation numbers, which are carefully calculated to make things look better than they are. I'm talking about what you actually experience when you go to the grocery store, when you pay your insurance premiums, when you look at housing costs, when you fill up your gas tank. The real cost of living has exploded. And here's the uncomfortable truth that nobody in power wants to acknowledge. It's not going back down. Once prices rise, they don't fall back to previous levels. That's not how modern monetary systems work. The best you can hope for is that the rate of increase slows down, but the damage is already done. Your savings, your retirement accounts, your cash reserves, they're all losing purchasing power every single day. Not might lose, are losing, right now, as we speak. Gold doesn't have that problem. Gold can't be printed. Gold can't be created out of thin air by central banks. Gold has maintained its purchasing power for thousands of years. An ounce of gold bought you a fine suit in ancient Rome, and it buys you a fine suit today. Can you say the same about any paper currency? Now I want to address something important here because I know what some of you are thinking. But gold doesn't pay interest. It doesn't generate cash flow. It just sits there. You're absolutely right. Gold doesn't pay interest. But you know what else doesn't pay interest? The purchasing power you're losing to inflation. At least gold maintains its value. At least gold has been recognized as money for 5,000 years across every civilization that's ever existed. And here's something else to consider. In an environment where real interest rates are negative, meaning the interest you earn is less than the rate of inflation, you're actually losing money by holding cash in a savings account. You might see your account balance grow nominally, but your actual purchasing power is declining. Gold solves that problem. Gold is insurance against monetary mismanagement. Gold is a hedge against the debasement of currency. Gold is what you own when you don't trust the people in charge to do the right thing. Let me tell you a story that illustrates this perfectly. Back in 2008, during the financial crisis, there was a moment when the entire global banking system almost collapsed. Lehman Brothers failed. AIG needed a bailout. Major banks were on the verge of insolvency. Credit markets froze up completely. You know what happened to gold during that period? It went from around $700 an ounce to over $1,900 an ounce within 3 years. While people were watching their stock portfolios get cut in half, while real estate values were plummeting, while retirement accounts were being decimated, gold was protecting wealth. And here's the thing. The conditions that led to that crisis never actually got fixed. They got papered over with trillions of dollars in money printing and bailouts. The underlying problems, excessive debt, over-leveraged financial institutions, moral hazard in the banking system, they're all still there. In fact, they're worse now than they were then. Global debt levels are at all-time highs. Government debt, corporate debt, consumer debt. It's all at record levels. And the only way this debt can be managed is through inflation, through devaluing the currency, through making the debt easier to pay back with cheaper dollars. That's not a conspiracy theory. That's basic economics. That's what governments have done throughout history when they get themselves into unsustainable debt situations. They inflate their way out of it. And who pays the price? Savers, people on fixed incomes, anyone holding cash. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the markets right now. The COMEX, which is the major exchange where gold futures trade, has been seeing some really interesting dynamics lately. The amount of gold available for delivery has been declining, while open interest has been increasing. What does that mean in plain English? It means more people are holding contracts that give them the right to take physical delivery of gold, but there's less physical gold available to actually deliver. This is what's called a squeeze. And when squeezes happen in commodity markets, prices can move violently higher very quickly. We saw this with nickel a few years ago when prices went absolutely parabolic in a matter of days. We saw it with oil when it briefly went negative during the pandemic. These aren't normal market moves. These are structural dislocations that happen when the paper market and the physical market get out of sync. And gold is setting up for exactly that kind of scenario. Here's another piece of the puzzle that most people don't understand. The gold mining industry is not keeping pace with demand. It takes years, sometimes decades, to bring a new gold mine into production. You have to find the deposit, get permits, build infrastructure, extract the ore, process it. It's an incredibly capital-intensive, time-consuming process. And you know what's happened to gold mining stocks over the past decade? They've been terrible investments for the most part, which means there's been underinvestment in new production, which means supply is constrained, which means when demand increases, like it is right now with central banks buying aggressively, there's no way to quickly increase supply to meet that demand. Basic economics tells you what happens next. Price goes up. And it doesn't just go up a little bit. It goes up a lot. Some analysts are projecting gold could hit $5,000 an ounce within the next year or two. Some are even more bullish than that, talking about $6,000, $7,000, even $10,000 an ounce if we see a real monetary crisis. Are those predictions guaranteed? Of course not. Nobody can predict the future with certainty. But what we can do is look at the fundamentals, look at what the smart money is doing, look at historical patterns, and make informed decisions based on that information. And right now, all of those indicators are pointing in the same direction. They're pointing towards significantly higher gold prices. Let me give you another historical example. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's the equivalent of about $3,000 in today's money. So we're already above the inflation-adjusted all-time high from the last major gold bull market. But here's what's different this time. In 1980, it was primarily retail investors and speculators driving the price. This time, it's central banks, it's institutions, it's sovereign wealth funds. This is smart money, not dumb money. This is patient capital, not hot money looking to flip for a quick profit. That makes this move much more sustainable, much more structural, much more likely to continue for years rather than months. And think about the geopolitical implications of what's happening. We're seeing the emergence of a multipolar world. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternatives to the dollar-dominated financial system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. They're accumulating gold as a neutral reserve asset that doesn't give any one country an advantage. This is a fundamental shift in how the global economy operates, and it's happening faster than most people realize. You know what's really telling? Look at what billionaires and hedge fund managers are doing with their personal wealth. Ray Dalio has been vocal about owning gold. Stanley Druckenmiller has talked about gold as a hedge against fiscal irresponsibility. Paul Tudor Jones has said he's long gold. These are some of the most successful investors in history, and they're all saying the same thing. They're not saying this because they're gold bugs or conspiracy theorists. They're saying it because they understand monetary history. They understand what happens when governments print too much money. They understand that every fiat currency in history has eventually failed, and they're positioning themselves accordingly. Now, I want to be clear about something. I'm not saying you should put 100% of your wealth into gold. That would be foolish. Diversification is important, but I am saying that if you have zero exposure to gold right now, you're taking on more risk than you probably realize. Think of gold as insurance. You don't buy homeowners insurance because you think your house is definitely going to burn down. You buy it because if it does burn down, you want to be protected. Gold is the same thing. It's insurance against monetary chaos, against currency debasement, against the failure of the current financial system. And unlike most insurance, which costs you money every year in premiums, gold has the potential to actually appreciate in value while it's protecting you. That's a pretty good deal when you think about it. Let me tell you about what happened in Venezuela. This is a real-world example of what can happen when a currency collapses. In Venezuela, the bolívar has lost essentially all of its value. Hyperinflation has destroyed the savings of an entire nation. People who had their wealth in the local currency saw it evaporate. People who had gold, they were able to preserve their wealth and even use it to escape the country if they needed to. That's an extreme example, and I'm not saying that's going to happen in the United States or Europe or other developed nations, but it illustrates the principle. Gold is portable wealth. Gold is universally recognized. Gold is money that works anywhere in the world, regardless of what's happening with local currencies. And here's something else to consider. We're living in an increasingly uncertain world. Geopolitical tensions are rising. The risk of conflict is higher than it's been in decades. Economic inequality is creating social instability. Climate change is creating new risks and uncertainties. In times of uncertainty, people flee to safety. And for thousands of years, gold has been the ultimate safe haven asset. When everything else is falling apart, gold holds its value. When trust in institutions breaks down, gold remains trusted. When paper assets are being questioned, gold's tangibility becomes valuable. The smart move right now is to position yourself before the crowd figures this out. Because once everyone realizes what's happening, once gold becomes the obvious trade, it'll be too late to get in at reasonable prices. The move will have already happened. Think about Bitcoin for a moment. I'm not here to bash Bitcoin. It's had an incredible run, and has created enormous wealth for early adopters. But you know what the common refrain is from people who missed out on Bitcoin? I wish I had bought it when it was cheap. I knew about it early but didn't pull the trigger. I'll buy it on the next dip. Don't make that same mistake with gold. The opportunity is right here, right now. The fundamentals are screaming at you. The smart money is showing you what to do. The question is whether you're going to act on it, or whether you're going to look back in a year or two and wish you had. And here's the beautiful thing about gold. It's not some speculative technology that might work out or might not. It's not some startup that could go to zero. It's not dependent on any one company or government or system. Gold has been valuable for 5,000 years and will be valuable for the next 5,000 years. That's about as close to a sure thing as you can get in investing. The way I see it, you have two choices. You can continue doing what you've been doing, holding primarily paper assets, trusting that the system will continue to work the way it has, hoping that inflation will magically go away and that governments will suddenly become fiscally responsible. Or you can look at what's actually happening in the world, recognize the signs that the smart money is seeing, and position yourself accordingly. You can own an asset that has protected wealth through every crisis, every war, every currency collapse, every financial panic in human history. The choice seems pretty clear to me. Now I know some of you are thinking, but gold is already at all-time highs. Isn't it too late to buy? And I get that concern. It's natural to feel like you've missed the move when an asset is making new highs. But here's the thing. Gold made new all-time highs in 2011 at around $1,900. Then it went through a multi-year correction. People who bought at the top in 2011 and held on are now sitting on gains of over 100%. And we're just getting started on this leg of the bull market. When you're in a structural bull market driven by fundamentals rather than speculation, new all-time highs aren't the end of the move. They're just milestones along the way. Gold at $4,000 might seem expensive now, but if it goes to $6,000 or $8,000 or $10,000, you'll look back and realize $4,000 was actually cheap. The key is understanding why the price is moving. Is it moving because of speculation and hype? Or is it moving because of genuine fundamental factors that are likely to persist? In gold's case, it's clearly the latter. Central bank buying isn't going to stop. Fiscal deficits aren't going to magically disappear. The structural problems in the global monetary system aren't going to fix themselves, which means the factors driving gold higher are going to continue, which means this move has legs, which means there's still time to position yourself, but that window is closing. Let me give you one more piece of evidence that this is real. Look at the gold to silver ratio. Historically, this ratio has averaged around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, that ratio is elevated, which suggests that silver is undervalued relative to gold. What does that tell us? It tells us that when gold moves, silver typically follows with even more volatility. It tells us that the precious metals complex as a whole is in a bull market. It tells us that this isn't just about gold. It's about a broader shift away from paper assets and toward hard assets. And if you look at other commodities, copper, oil, agricultural products, you're seeing similar dynamics: supply constraints, increasing demand, underinvestment in production capacity. These are all signs of a broader commodity supercycle that's just beginning. But gold is special. Gold is money. Gold is what central banks hold. Gold is what you want to own when the monetary system is under stress. And make no mistake, the monetary system is under stress right now, even if most people don't realize it yet. The cracks are showing. Bank failures, currency volatility, sovereign debt concerns, trade wars, sanctions, de-dollarization. These aren't isolated incidents. They're symptoms of a system that's breaking down. And when systems break down, you want to own the assets that survive the breakdown. You want to own the assets that have survived every previous breakdown. You want to own gold. So here's what I want you to do. I want you to take a serious look at your portfolio. I want you to ask yourself honestly whether you're positioned for what's coming. I want you to consider whether having zero exposure to gold makes sense, given everything we've discussed. And if you decide that it doesn't make sense, if you decide that you should have some gold exposure, then don't wait. Don't try to time the perfect entry point. Don't wait for a pullback that might never come. Start building a position now, while you still can at prices that will look cheap in hindsight. Because the best financial decision you can make today isn't about chasing the hottest stock or the latest crypto. It's about protecting what you've already built. It's about preserving your purchasing power. It's about owning an asset that will still have value no matter what happens to the dollar, to the stock market, to the banking system, to the global economy. The best financial decision you can make today is to buy gold. Not because I'm telling you to, but because the evidence is overwhelming. Because the smart money is showing you the way. Because history is screaming at you to pay attention. The question is whether you're listening.